Now, TISA company is considering an opportunity. So the first requirement is reasoned estimate that the TISA should use to calculate the NPV of two processes. Estimate of cost of capital. TISA company is considering an opportunity to produce an innovative component which, when fitted into motor vehicle, will enable them to utilize fuel more efficiently. The component can be manufactured using either process, omega or zeta, although entirely new line of business for TISA. It is opinion that developing either process over a time period of 4 years and then selling the productions right at the end of 4 years to another company may prove lucrative. Cash flows are here, process omega and process zeta. TISA has 10 million 50 cent share trading at this. Loan has current value of this. And after tax cost of debt is this. Capital structure is unlikely to change significantly following the investment in either process. FLU company manufacture electronic parts for car, including the production of a component similar to that one considered by TISA. FLU is proxy company. FLU is proxy company. FLU company's equity beta is 1.4, and it is estimated that equivalent beta for other activities. So FLU has other activities as well as this component. Two activities. So overall equity beta is this FLU's, and beta of other activities 1.25. It has $400 million 25-cent shares in issued trading at 120 cents each. Its finance consists of variable rate delivered 7 years time. The loan paying interest at a base rate plus 120 basis point above have a current value of 96 million. It can be assumed that 80% of debt finance and 75% of equity finance can be attributed to other activities, excluding the component production. Oh my goodness. Both companies pay annual corporate taxes. Yes, students, this paragraph is very important. I would suggest you to read it carefully. FLU. Now, so I'll be opening Excel sheet. We are going to solve it, this question as well. So, new. And the question name is TISA company. Risk adjusted WACC and MIRR. Sorry, we can't write here. Okay, no worries. So let us try to solve this question. Right screen, yes. Yes, what we need to calculate? Cost of capital for new business industry. So what we need? When we want, what is needed? For your clarity, in exam you will not write it. What is needed? A beta equity for TISA, which has two things. Business risk of new component process. Yes. New component production and financial risk of TISA. How we will get it? So this is planning the question basically. Okay. Although it is not required by examiner, you are doing it for yourself. So we have proxy company. The name is Elfu. Its beta equity is equal to 75 per two things. 75, yeah. It has two things. One is business risk of two businesses. Component plus that component we want to launch. Other activities. And financial risk of Elfu. We have done the analysis. So first of all, we will get business, beta asset. This. Then we will adjust it and get beta asset of only component. Re-gear it and get this one for it. If you do analysis, proper analysis, you can solve it easy. Analysis is very much important out of this information. So much huge information. So let us proceed further. So starting the question now. I have not started the question yet. So what I'll be doing, Elfu companies, first of all, we will write all the data here. TISA company and Elfu company. TISA company, it's 10 million 50 cent share trading at this. So market value of equity. 10 million shares, each market value 180 cents, $1.8. 10 million shares, each $1.8. Market value of loan. That is $3.6 million. Post-tax cost of debt. Sorry. That is 4.5%. Now, come here, Elfu company. Its market value of equity. $400 million shares, each trading at $1.2. Right? Its beta equity is 1.4. Overall beta equity. Its market value of debt that is $96 million. Now, the next is overall asset beta of Elfu company. Overall asset beta. equity beta into equity plus debt into 1 minus tax rate, 25%. The same formula. We need beta. Just a minute. We need beta assets. Sorry. So we need to apply equity beta into equity divided by equity plus debt into 1 minus tax rate. Here we are. Asset beta overall. Now, we know that asset beta overall of L4 company, it has two parts. Equity beta, two activities. One is component beta asset plus other activities. And they say other activities, 75% of equity finance, equity we will take, proxy. Other activities, it is 75%. And it is 25%. This is the equation. This equation is very much important. Okay. This equation is very much important because it will lead now us. So we have got this overall asset beta. Then they said equivalent beta for equity for other activities is 1.25. So beta equity of other activities 1.25. And then they said 80% of debt. How much is the debt invested here? 80% of it. Okay. And equity, 75% of equity is invested in other activities. So beta asset of other activities, applying the same formula of beta asset, this into equity over equity plus debt into 1 minus tax rate. So beta asset of other activities is here. So we have beta asset of other activities. We have overall asset beta. We can get this component asset beta, but we need it. We get that. So beta, so the equation will become, this equation I'm going to form. 1.22 is overall beta. Component beta asset into 25% plus other activities 1.078 into 75%. Here is 75%. So we can get it. We can get it. So beta asset of component 1.22 minus 1.078 into 75%, right? Divided by 0.25%. Yes, so this is beta asset of component production. We got that. So now we can easily get that. Beta equity of TISA company for new business. Yes. So beta equity re-gearing it. Okay, re-gearing it with capital structure of TISA company to get beta equity. So re-gearing it. Now, so beta equity equal to beta assets into equity of this, plus debt of this into 1 minus tax rate divided by equity. The formula. So this is the desired beta equity obtained and calculated. And cost of equity is equal to risk-free rate, 3.5% base rate, plus risk premium, equity is 5.8%, into beta equity, capital asset pricing model. Yes. Capital asset pricing model. We know that their cost, post-tax cost of debt is 4.5%. Yes. Cost of debt post-tax, that is equal to this. So WACC equal to equity divided by equity plus debt. You can see the formula here. P plus debt into cost of equity plus debt divided by equity plus debt into cost of debt. Yes. The WACC. Sorry. Happened. Here is the answer. 12.8%. 12.8%. If there is any confusion, you can ask. In this WACC calculation, if there is any confusion, any point you want me to re-explain, I am ready to re-explain happily. Now, So we have done it. Calculate the IRR and MIRR of process omega, B part. Process omega. So we have to write its cash flows. Here 0, 1, 2, 3, and 4. Post-tax cash flows. 3-digit round off. Negative 3,800. 1,220. 1,153. 1,386 and 3,829. Cost of capital, what is that? Okay, we have calculated above WACC. Okay, now they say IRR and MIRR. So first of all, IRR. IRR. MIRR. Now, WACC is the both rate. Investment rate as well as discount rate is the same. WACC we calculated for these processes. It is 23%, 22.7%. Process omega. So they say that recommend which should be taken. So process zeta, they have given IRR. It is given 26.6% and MIRR 23.3%. Yes. So students, as per IRR, IRR is higher of omega, MIRR is higher of zeta. So which recommendation? Explain the recommendation as well. Okay. Now, students, the point is, as per the calculation above, process omega has higher IRR than of 27.3% than that of zeta 26.6%. While so IRR is recommending the process omega while MIRR is recommending zeta as MIRR of zeta is 23.3% and is higher than that of omega at 22.7%. Although differences are not substantial, but recommendation of IRR, MIRR is more relevant and should be considered as IRR has a flaw, IRR method, that it considers that cash flows are reinvested at IRR rate, while MIRR assumes that cash flows are reinvested at cost of capital of 12.8%, which is a valid assumption by MIRR. Hence, process zeta should be undertaken. You see, logic, giving the relevant data, this has professional marks. When you're utilizing the numbers, you are discussing and validating your logics, explaining the assumption, of course, logically. So these all, even the calculation, presentation of calculation, that has professional marks as well. So some marks are for this discussion. Very important. You get a technical mark as well as professional. The next is value assets. LFU has estimated an annual standard deviation of 800,000 on one of its other products based on a normal distribution. The annual return on project is $2.2 million. Okay, so it is quite easy. We need to calculate it. So, C part. They say standard deviation, variation of cash flows, 800,000. 99% confidence level. So value at risk at the rate of 99% confidence level. Please tell me the 1% value at 1%, 99%. Tell me, please. Tell me the value of K at 99%. Check and tell me, please. You should memorize that. 2.33. K into standard deviation into number of year for 1 year raised to power 0.5 under root. Nth under root. Yes. And for 5-year life, for 1 year. This is for 1 year. And value at risk for 5 years. At same confidence level. Value of K, 2.33 into standard deviation into 5 raised to power 0.5 or 1/2. This is how it is calculated. In my opinion, 2 marks will be for calculation and 2 marks will be for discussion, explanation. Same is the case in the above. 4 marks will be for calculation, 4 to 5, and remaining will be for discussion. So discussion, how to discuss it. So the mean, it means that cash flows on the project will not fall more than 1864 000 over 1 year, and LFO company can be 99% confident about that. Now, so next, and LFO can be 99% confident that cash flows will not fall by more than 416,8031. 416,8031. Yes. Over its life of 5 years. And there is only 1% chance that it will exceed that. The loss will exceed 416,8031 over 5 years. So interpretation. Yes. So let me show you how marks are awarded. Let me show you professional marks. Let me open the 5 professional marks. Here, appropriate use of data to determine suitable calculation. Appropriate use of data to support discussion and draw probable conclusion. For example, we drew appropriate conclusion here. This one. A discussion. Okay. Now, recommendation. Okay. Challenging information and assumptions. There was nothing like this here. Okay. Now, ability to consider all relevant factors. Just like that, we considered here IRR has flaws. This factor we considered. Recommendations are practical and plausible in that context of the company. Effective use of example and calculation. Yes. So nothing is a rocket science here. We have done the same. Okay, students. So that's it for today.